Hello, everyone, and welcome to the Sleep Well Portfolio and Awake monthly meeting for October of 2023. Okie doke. We are going to dig into everything that we normally do. So first things first, we're going to go through our disclaimer, and then we'll go through basically what it's going to lay out. If this is your first time joining us, don't be afraid. We'll go through kind of how we lay these out, and this will be a pretty large data dump, so it should be pretty fun for what is going on because there is a lot of excitement in the markets right now. Anyways, without further ado, let's go through the disclaimer. Our Environmental Trading Edge LLC and its members are not broker-dealers or investment advisors. All webinars, seminars given by Environmental Trading Edge are for members and for educational purposes only. Options, futures, all that stuff not suitable for all investors. Past performance is not indicative of future results, and this is for personal use only, non-commercial use. Okay, now that we've got all the legalese out of the way, let's start jumping right in. By the way, you can always throw a question right in the chat on YouTube, and I will answer it live. If you throw something in a comment after the fact, I probably won't see it unless I see it underneath the, like you can put in some comments like you normally can on YouTube down underneath, and I can answer some questions after the fact. Of course, if you're part of environmentaltradingedge.com, you can come over there and just, if you're in the forums, you can send a question via forum or things like that too. But going through this is how we typically lay out these monthly meetings. We go through the current allocations, which have changed pretty dramatically since last time we talked. And then we'll go through the performance to date of both portfolios, the Awake and the Sleep Well. Two very different portfolios, as some of you guys felt this month. Performance analysis of each individual asset, and then we'll go through the macro analysis as far as what is going on in the world. And it is going to be a heavy one today. So we're basically going to be talking about, we've been talking about a lot of things that are just now showing up in the news. So we've been a little bit ahead of schedule, and we'll probably talk about some more things that are, yet again, probably ahead of schedule. So then we'll go through questions, but of course, you guys can ask me questions along the way. These are just pre-done questions that have already been sent to me, and we will crush those out as well. Periodically, I will check back in on you guys and see if there's been comments and stuff. I don't necessarily see it right on my screen. So, and just to check and make sure, let me just verify you guys are all yep, okay, everything's looking good. Okay, so where is the allocations to date? As you guys saw with the Sleep Well portfolio, the Sleep Well portfolio stayed in UUP basically consistently through the rollover, and that has tremendously benefited this portfolio for the fall, and I'll show you that on the graph next to us. But yeah, you can basically see everything's kind of rolling over back here, and we'll go into this more a little bit. But there is some pretty large numbers for just a 1 week number, right? 4% on gold and bonds. So things have been pretty melting down, right? You know, TLT is down, 14% year over year. So it's a pretty big deal right now. So we had a little dash of the Russell in here, and this was mainly because we always are pulling in basically capital flows, and we're pulling in where the money's coming in from, and is it growth? Is it being printed? Is it, is it bullish for growth assets? Things like that, right? So as we're pulling in all this data, as we're pulling in all this data, sometimes we get little signals of IWM and things like that. And one portfolio is more sensitive to these than the other, and the Awake is much more sensitive to this, which you guys saw that basically on the worst week that could have happened, but it is what it is. We've been through this with Awake before. So, I just realized that I have that misspelled. So thanks everyone. Anyways, I will fix that afterwards. So anyways, as we go through here, the portfolio changed this week. If you're over at eTrading Edge, this is what you typically see. We are up just a little bit for the week. And our leverage under high water, we're definitely, if you're doing that, you've been 3x leveraged. All right, and as far as the portfolio is concerned, just kind of how it looks month to date, we are up just about 1% for the month from last time I talked to you guys. Not very much, I realize. It's nothing amazing, but it's a whole lot better than melting down and everything else. So we will take it as what it is. The sleep well portfolio is not nearly as aggressive as Awake, but what it does do, or what it makes up for from lack of volatility, it makes up for on just outright defensiveness. So it definitely is a little bit more defensive, and we are climbing and on our way up to recovering our high water mark that we made briefly last year during the recession the first time around. So fortunately, we should not have a repeat of the exact same cycle that we had last time. We should actually have a nice little steady up push from over here. We should just kind of stay nice and steady up here this time around. So because UUP will be what it is, and then what that'll do is it should we will cycle into bonds and stocks. So all right, as far as risk parity, this is actually almost getting comical at this point. As I told you guys, if you guys haven't been with me since the beginning, basically the point was making this portfolio was that I saw a major issue in the 60/40 stock bond portfolio and the risk parity in the macro, the very, very large macro cycle that we were about to go into, and that bonds were really going to be a problem. And both the risk parity in 60/40 and 50/50 and 70/30 and all of those, stock bond mixtures were really going to have a problem. And then, of course, stocks were going to have a challenge as well. And so the goal was to make a portfolio that wasn't so dependent on bonds and would still adapt to the business cycle. And so risk parity was originally like, this is what we were going to compare ourselves to, and I still do, right? I mean, we're blowing it away. But the point is that at the time of creating the Sleep Well portfolio and then eventually launching it live with you guys, the whole idea was that was the creme de la creme of safety, right? Full risk parity. That's the best way to just have a really passive portfolio that just kind of sits there and you just rebalance it occasionally. We rebalance ours on a weekly basis, but it is pretty much a set it and forget it just on a weekly basis. We're not doing anything crazy. We're not watching anything, no technicals, no heavy deals, right? So it's a very easy portfolio to manage, and we are doing phenomenally well compared to Mr. Risk Parity down there. So anyways, we will keep up the good work. This is, like I said, this is a huge delta between us, right? 31.22 total versus a loss so far of, actually it's more than that right now. I realize I did not update that number, so you can actually tack on this 9% to that one. So it's down there very, very, very far. It's pushing into new lows right now. So it's a large difference. In fact, in order for you to come back from this is just kind of an idea, right? If you were invested in risk parity, in order to come back from this at its historical rate, right, it would actually take us 15 years. Interesting. So I will move on. Awake. So the Awake had a heck of a doozy because of its fake out into URTY. We leveraged that week too, so we just kicked into new leverage. It was basically kind of like a worst time scenario. I was, in a perfect world, we would have been 1 week off, right, and then everything would have been perfect. But we weren't, so we were leveraged up into URTY 100%. It's basically the riskiest allocation you can have. So congratulations, you have officially gone through a crash in the most risky allocation that we can do in the Awake and survived it. So from here, we will crank it up. Just to kind of keep this in mind, right? We are leveraged 3x. This is a 3x leveraged portfolio. So just to keep in mind the type of assets and the type of performance that we have to kind of deal with is, 43 and 44% in a leveraged bonds, right? Year over year, 90-day change, right? This is very, very large numbers, right? So this cuts the other way, right? When we finally get into some sort of actual bull market again, or when we've actually got assets that aren't just completely annihilating themselves except for the dollar, we will eventually have very, 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 very strong years of, 45, 55, 100, 120% a year. Just right now, everything is just nuking itself. So I'm pretty happy just to kind of tread water right now until we get some really big booming stuff. And we don't know when that is, but the portfolio will take care of it. All right. Sorry about that. My scroll wheel is going nuts over here. All right. So this is not up to date, by the way. So going through here, Awake. We've actually pulled down right here. This is what I've updated right now. This is our loss. This is pretty much equivalent to what we've had before. It's actually a little bit less than what we've had before. These were when I believe it was like gold rolled over, but inevitably gold actually is what gave us our wins that kind of came through. Same here. So I think stocks kind of gave us our hit, and then eventually gold gave us our rally. And so that's pretty likely what we're going to have happen this time around. Gold will actually be a very, 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 very good asset here very soon. But right now I wouldn't touch it with a 10-foot pole. So let's start cruising through the assets right here and just kind of seeing what's happening from a different perspective. And coming back here and lining up, we can see that we have all the assets that the sleep well uses, right? This is very clear. The dollar is the king. Everything else is getting eroded, and there's one reason why, and it's because there is a tightening monetary environment, and dollars are being sucked out of the system, right? And as inflation continues to go higher, it projects the U.S. bond market, it projects our treasuries and bond market to actually increase yield. That is tightening, that destroys dollars, right? Because we work on a debt system. So this can be kind of complicated, but just imagine that when there's tightening in the credit markets, right? Bonds, credit markets, things like that. What we are in essence doing is we're taking money out of the piggy bank, right? And so there's less money to go around. Well, if there's less money to go around, then each unit of money is actually worth more, right? And so that's why the dollar is getting stronger. So tightening environments, especially when we're getting an even more tightening environment, is really good for the dollar, especially because the euro is basically getting annihilated over there. So just to keep in mind that this month, I mean, look at these numbers, right? This month, I mean, it's been a death sentence for everything this month. So Awake wasn't the only one that got nailed. The sleep well portfolio is actually doing really well. Not as good as UUP, just because we still had a little bit of, we weren't quite sure if the recession was getting kicked off yet, right? The models, I told you we're going to pick up on it pretty soon. Last month, I knew that we were going into this recession. We talked about this. We knew that October was going to be kind of the kickoff, and sometime in September was really where we were going to kind of start showing up. And so it started happening just a little bit earlier than September, but this is pretty typical for us. We'll stay a little bit allocated, but we'll have a little bit of defense with a little bit on the brake pedal. And then it's finally when things kind of roll over, we'll just drop the gas and hold on the brake pretty hard in defense mode. So it's worked out really nice. So I'm going to zoom out here as we always do, and we look into individual assets and just kind of look at what's happened over the last year, right? So the S&P drove all the way down to these lows that were back here. The Feds tried to ease off the gas on a little bit as far as tightening is concerned. That started to kind of curl everything up, right? And then this is when the reverse repo market started to drain. So we created a new little bubble. So that should have never showed up. Like everything above this level is bullshit. Man, excuse my French, but this is complete BS, right? This this is my little mouth that I shouldn't be talking right now. This is all just bubble. So now that we've kind of reverted this and we've eroded this bubble, now we can kind of go back to, okay, what's really going to happen in the economy and what's really kind of driving fundamentals. And unfortunately, it is further down, but we should get some sort of support right here on a technical basis, right? And then eventually we'll roll over more, right? So just keep in mind, that's kind of probably how likely it's going to go with the S&P. And then the bond market is in basically meltdown mode. So this is one of those parabolic sell-offs, right? So this is crashes. This is a crash in the bond market. And when you get this parabolic selling off on the downside, this is margin calls, right? So you can, brokers are calling institutions. Institutions are selling their assets. As they sell their assets, it pushes the price down further. As it pushes the price down further, they have to sell more assets. The leverage comes out of the system. This is what happens because everyone uses leverage, or everyone uses bonds as a leverage backstop. Like that's their kind of buffer. What you can do, just to kind of explain this a little bit further, is you can actually use bonds or treasuries, and you can actually go to your broker and basically trade against them as cash value, right? So it's basically free yield, right? So you go buy a bunch of treasuries, you're 5%, and then your broker will actually let you trade with that money that's actually sitting over there in the treasury. Keep that in mind. Lots of institutions do this. And in fact, almost all of them do. And ETFs do this as well. Lots and lots and lots of ETFs actually use bonds as a devolatile, or like a devolatilizer. I don't even know how to say that right. But what they're doing is they're reducing the volatility by watering down the allocation with bonds. But normally they're on shorter yield, and so they get yield rather than too much volatility. But these longer term bonds are really having a problem. And that is mainly because basically the inflation is starting to reaccelerate. And the concern in the bond market is two things. One is that no one really wants U.S. debt because, it's a problem with paying it back right now at the current debt load. And then at the same time, inflation's reaccelerating. So there's twofold right there. Basically, the U.S. has pushed as much, U.S. debt onto the market as the market can bear, and it just doesn't want it anymore. It's basically like Greece austerity crisis again. It's the same situation. So the yields just crack out and they go into la la land for a while. There is a golden little parachute back here that we'll talk about momentarily, but give me a little bit until we get into the macro stuff. All right, so on the side of the S&P, or on the side of gold, I get a lot of questions about gold. Hey, gold this, gold that, what's going on with gold? One thing is that gold follows real interest rates, and real interest rates are dropping, right, as acceleration reinflates and as the dollar gets stronger. So in general, gold is not a very good asset to have while we're having these types of macro environments. Now, inevitably what happens, just like what you guys saw last year, inevitably what happens is you get a reacceleration in gold as the dollar gets devalued at the end of a recession. So this is very, very, very common to have kind of a big spike up in here. So if you guys remember that, it's very common. So likely what we're going to do is we'll likely trend south as real interest rates kind of cool off a little bit. They should be somewhat near a bottom, and then eventually gold will be really great. So, and then the UUP. This has of course been our strengthening guy. As soon as basically the bond market started to have problems, and the tightening credit, and basically institutions started pushing into cash, UUP goes straight up. We started going into UUP around back here, and we've been slowly legging in and legging in and legging in as the recession got closer and closer and closer, probably like every other institution. So that's why it's probably going up. All right, the S&P 500, or the Russell, sorry, the small caps, right? FTSE Russell, man, this thing is This thing's in basically a nightmare meltdown. The reason why this is a really, 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 really big problem, and I was not keen on how the portfolio was basically getting any kind of allocation into IWM, but every recession is a little bit different. And this recession is really, predominant tightening credit, with commercial real estate being a very big problem. And there's this big undertone that I just don't think people really even understand how big of a problem the commercial real estate market is. It is monumental. It's much bigger than the housing market in '08. The reason why is because there's really no, back in the day, what you had with, at least in 2008, is you could repossess, or you could, the bank could foreclose on you, and they would get the asset, and then that asset would then be sold, right, and things like that. So there was at least a mechanism for the owner or the lender, or not the lender, but the person that ended up originating the loan to deal with a foreclosure event. Well, in the case of commercial real estate, there's really not any mechanism for that, right? There's not a foreclosure. There's not a bankruptcy that you can just, you could with a business, you bankrupt the business, which that's kind of what we're going to start seeing. We're going to start seeing this erosion in the real estate market. And it's not going to necessarily be single family homes, although it will spill over into that. But the deal is that the commercial real estate will really be inevitably the front and center issue that people are going to focus on, because it is blowing up. It is already blowing up. It's going to blow up further. And it's not just work from home. It's the fact that you loan out money at a very cheap amount, and then you're assuming that you're going to fill these buildings and towers and with tenants, and then those tenants, you're actually really low. And so what happens is you get like a filling of like 40% or so, but because the cost to carry the debt is so cheap, you don't care if you really have that many tenants. So you can crank the rent, you can have only just a few in there, and that's actually what the equation is. Crank the rent high enough, keep the tenants low enough to where you can maximize your return with the least amount of effort to deal with as many tenants, right? You don't want to deal with many tenants. And this is that, real estate interest trust environment that we've created since '08. Anyways, I'm going on to a little bit of a spiel here, but I just want to explain that, this is where the origination is. This is what's going to blow up the market right here. This and the fact that no one wants U.S. debt. Right? Those two things are the death sentence. So we are going into a depression. It is a depression. We are already in a depression, and this is just going to be how it is, and hopefully everyone's prepared for it. Anyways, here we go. And so this is the EEM. EEM is actually, I would say EEM is a better asset. I was significantly more bullish on EEM than the S&P, but what happened was the Fed started playing phony money and pumping in this money from the reverse repo market, and it started to outperform EEM, which really started to mess with some of the models, because EEM actually should have been the higher performer, and the S&P realistically should have been down here all along, but this extra pump up has actually kept it up here a little bit. So anyways, new money coming into the system from printing from the U.S. dollar. Thank you, Fed. And that has propped up the S&P 500. Okay, so running through what it looks like on the board here. Let me find my marker. There we go. So 6.65 for the S&P. UUP is our big winner here. TLT and IWM are both in double-digit territory. Ooh, ouch. Gold is not too far behind, and then EEM is right there with gold. So it's definitely a bloodbath out there, except for Mr. Dollar. We are early into this recession. It is just like 2022 in the very beginning. We had to push into UUP because we just can't go into bonds. And trust me, I'm sure some of you guys are thinking it, and I know some of you guys have already emailed me saying thank you, but yeah, there's a reason why we choose not to be in bonds. If you try to just go into bonds thinking that bonds are going to save you during recessions, they don't. In certain recessions, like what we're dealing with right now, they are not the thing that you want to deal with. Eventually, they will be great. They will be great again, but get them, later on, right? And I'm not saying that right now is a bad time. Like, it's honestly not terrible to start kind of loading in. Just know that you're trying to catch a falling knife. So, take it with a grain of salt. You're going to, maybe lick some wounds for a little while. And then the bounce back won't be nearly as strong as what it was in '08 and stuff like that, because inflation will be too high for it. So keep that in mind. Scroll wheel again. So the S&P, or the sleep well portfolio, was able to pull out a positive in the middle of all this bloodbath. Yeah. And the awake unfortunately got nailed by that 1 week. That 1 week, man, that really sucked. But remember, he is 3x over here. So 3x, by the way, keep in mind that this gets wiped out in about 1 week on a good upside. So keep that in mind. We are 3x, but remember, UUP is not 3x. So what we do is we basically sit aside. And by the way, if you're an options person or something like that, and you wanted to leverage a little bit more, the proper leverage here is actually to kind of maximize things a little bit. You can actually go all the way up to a higher leverage of 5, 3, 2, and then 5, 2. So those are actually the numbers right there. If you wanted to try to use some options, or use some options to leverage up, if you're an options person, if you wanted to try to get your leverage up there, so that way you could actually get UUP leveraged up. If you wanted to kind of push things a little bit further, just know that comes with its own challenges, right? Doing options. All right, where are we? So I always go back through of where are we? Well, in all honesty, we really don't have a better proxy than basically the beginning of 2022, right? We had a small little lick that we had right in the little dip, and then eventually we popped out really nicely and eventually made our new high water, until eventually we kind of got nailed by with the Fed kind of pivoted early on us. So that kind of took the portfolio for a little bit of a shock, churned out for a little while, and then, we're where we are, right? So we're just below high water on the sleep well portfolio, just about, I think, 4-point-something%. Pretty easily doable in like a week or two to get that up to high water, depending on how things play out. All right, the U.S. Treasury / yield spread. All right, we're going into macros now. So this is the heavy macro stuff. So hopefully you're ready, because we haven't even dipped into this stuff. So the stuff that I've talked about has just been kind of off the cuff. Now we're going to get into some of the data. All right, so digging into some of the data, and I'm going to check back in on you guys, make sure no major questions have popped up or anything like that. Nope, we're doing good. All right, guys, deer in the headlights, and we are listening to what's going on. Okay, so we uninverted. I have said this time and time again. I am not scared of the inversion of the yield curve. I am scared of the uninversion of the yield curve. Why is that? Because every uninversion of the yield curve is actually when the recession kicks in. So as you see, inversion and then uninversion. That's when it starts to go down. Inversion, uninversion. Right? So just even before COVID, inversion, uninversion. Right? This is just the cycle we go through, right? Even in the inflation time period, what happens in an inflationary recession is typically the uninversion happens a little bit inside of the recession. So a little bit different. So this is basically where we're at right now. I believe what they will do is they will eventually push back, and they will push this date almost right smack on here of where the recession started, right here in October. So We called it. We've been talking about the fact that the recession got pushed out. So we were supposed to have it last quarter. It was supposed to be middle of the year. With the Fed kind of dancing around and not tightening as much as they did, it was going to push inflation higher. We were going to reaccelerate, and we were going to push the recession further down the road, but it was going to be worse. So welcome. Now we're here, and it's going to be worse. So this is what we got, and the bond market's going to go crazy. The commercial real estate's going to blow up, and we're going to have to do some pretty major things. It's going to make 2008 look like a little kitten, so it's going to be quite interesting. All right, the current and recent Treasury yields. So we look at the uninversion. I will say that this is the first time, as you guys know, my age. Well, I shouldn't say my age really, but I mean I'm 35, and I've been studied macroeconomics, probably half my life, right? I've always been really interested in stocks and macroeconomics, and this is just kind of how I played, right? I invested in Apple when I was like 10, so it was kind of an interesting deal. So the whole point is there are patterns that we see in our lives, and this is a pattern that I've never seen in my life. And honestly, there's not a pattern like this in the United States. And the pattern that I'm talking about is the way that the uninversion of the yield curve is actually happening right now. So typically the way the yield curve works, and I'm going to kind of draw this out. So here's our yield curve model. Here's our typical yield curve, right? This is like a typical yield curve. Everything's really nice and hunky-dory, right? And I'm going to kind of draw this on the upside here. So when a recession starts kicking in, or when the economy runs a little too hot, what happens is the yield curve kind of starts to lift up like this as the Fed tries to deal with it, right? And you can see the back end of the yield curve lifts up, the front end of the yield curve lifts even higher, right? Until eventually you kind of uninvert, right? Or you invert. And they typically hold it like this because there's an inflation spike. And as this inflation spike kind of works its way out, it goes back the other way. So I'm going to draw a little time series over here. So this is time series 2. Typically that uninversion works like this, right? So you'll actually get the back end dropping down, and then all of a sudden you'll get this massive drop, and this is basically how the bond market acts, right? So from top to bottom, you kind of have the back end drop first, and it kind of re-steepens the yield curve. Everyone kind of freaks out typically, but it's actually a good thing. And then all of a sudden, the front end of the bond market starts to pull down, and then or the Treasury yield curve, and then eventually that turns into the bottom, right? And you start to stimulate the economy again. What is happening right now is the way that we are uninverting is, so let's just say that this is our inversion. The way that we're uninverting is not because the front end of the yield curve is coming down because the inflation spike is over. What's actually happening is no one wants the bonds that we're providing, and everyone believes, I say everyone, right? Other central banks, institutions, even our own domestic investors, right? They don't want them either. And so what's happening is the front end of the yield curve is kind of staying steady, but the back end is actually lifting up further. And this creates a whole new cycle of long-term inflation and even more tightening credit systems. And inevitably what this does is it makes the Fed need to raise rates actually more to tighten this down in order to deal with this. That's if it's inflation driven. If it's just straight up, no one wants US debt anymore, that's kind of a whole nother issue, and there's just a liquidity problem out there. And if there's a liquidity problem, the Fed will step up and actually print the liquidity. But in doing so, that will weaken the US dollar, and it will weaken the US dollar versus financial assets. So then what it'll do is it'll drive financial assets higher, because financial assets will actually have high inflation in them. Because remember, if you print dollars and you hand them to consumers, consumer prices go up. If you print dollars and hand them to banks, financial assets go up, right? You get financial inflation. And so that's when gold goes through the roof. That's when stocks go through the roof. That's when lots of that goes through the roof, but the underlying economy is actually going to go through a really hard time. So very different type of situation. Very good time to be invested in gold when that starts to happen, which we will be, I promise. So that's kind of how the cycle is going so far. It's the first time I've ever seen this in the United States. I've seen it in emerging markets. I've studied other emerging markets that deal with this. But it's the first time I've ever seen it in the United States. It's in fact, we're almost acting like a non-reserve currency right now. So quite interesting. We have matched the yields back here in 2008. Yep, we have basically matched those guys. So we are basically in an environment in 08, but we have a significantly higher inflation. We have doubled the pricing of houses. We have more than double the pricing of basically everything. But everything is to borrow is basically just as expensive as 08. So this is why we say that we're going through kind of a silent depression right now, is because the middle class is squeezed significantly harder than they ever were in the 08 type of environment. And that's because the interest rates dropping and things like that actually were somewhat stimulative, except for the housing, kind of debacle. All right, so odds of recession are basically coming down. Remember, this is because it's a proxy of the yield curve right here. So as the yield curve uninverts, this will come down, which is literally it's because you're not going into a recession, or you already are in a recession. So the likelihood of going into another one is low. I talk about inflationary cycles and things like that. This is basically what we're going through as the inflation cycle continues to go up, right? We might, I don't know if we will, but we might have to kick interest rates up again, right? And when you start to reignite interest rates, that's when stocks really start to crash. So we'll see what the Fed ends up doing, and we'll see how that goes. If we get a runaway inflation train, this is actually the situation that shows up, where stocks, rates, inflation all accelerate all at the same time, right? And that's because you just basically have one big giant inflation train. All right, so deflationary cycles are different. We won't talk about that right now. So let's crush through. This is the PE ratios. Even still, with a little bit of this pullback right here, we are still technically overvalued, but we are getting better into the kind of the sweet spot. Somewhere down here is probably a relatively good valuation point. And then here's our Buffett indicator, still way overvalued. This goes back to the fact that the GDP just isn't high enough in the United States for the premium that stocks have right now. So this basically will need to come down a little bit to be a little bit more attractive, but not too much. Here is the kind of underlying problem that everyone is kind of finally realizing, is the fact that our all items less food and energy, that inflation, that's the lighter red line back there. I know it's a little bit harder to see, but if you follow this line, the top one, that thing is not anywhere near our targets. And then we're starting to get a reacceleration in the CPI. And as that starts to happen, this actually might end up starting to curl up and stay high. And if that's the case, investors will need a higher yield on their bonds, and the current yield is not high enough for them. So that's kind of how that's going to play out. We'll see. I don't need to talk too much about this, but basically the dollar is just projected to kind of hold its own / get a little bit stronger going into the end of the year. And then the Atlanta Fed GDP now estimates, this is now backwards looking, right? This is last quarter. We knew last quarter was positive. We knew it was all fantastic. That's all great, fine and dandy. But of course, midway through, we knew that we were going to be looking at the recession, right? And the recession was coming. And so that's why we've been kind of talking about it. That's why we've been a little bit more defensive in the sleep well portfolio, things like that. Average weekly Overtime hours is still basically unchanged from last time we talked. But basically, you can always see that this is declining before a recession, right? So we knew that we are still going into a recession. It is not a new bull market like everyone was talking about 2 months ago. But you guys know that because you guys are here with me. So initial jobless claims are still just kind of steadily on the rise. Nothing too crazy. Same with unemployment, right? Unemployment really hasn't cracked out either. Basically, everything is kind of holding steady because we're so early in the recession, right? This is when people like don't realize that we're in a recession just because the numbers aren't bad enough yet. By the time everyone realizes that we're in a recession and the numbers really are bad, that's actually typically near the end because there's, we're going to do something to deal with it. So the personal savings, consumer price, I mean, everyone's feeling a little bit better right now, but this is about to start leveling off, right? So that will be kind of its own issue. The total assets from the Fed have really kept steady on declining. This does strengthen the US dollar, but like I said, the reverse repo market is actually more important right now because the amount of money in the reverse repo market versus how much the Fed is actually tightening is night and day, right? So the M2 money supply is still very, very, very negative. We are contracting. We are making stronger dollars because there's less of them going in circulation, as we talked about before. This is something that I changed here. So before I showed you guys net percentage of domestic banks that are tightening for like small business loans and stuff like that. This is a whole nother animal. What this actually deals with is credit card loans. So something to always kind of note is how difficult is it to get credit card loans, right? In 2000, you can see like it was still okay to get some money. Like it was fine, right? 2008, totally different story, right? No one wanted to give things. Look at now, right? We are basically almost, halfway to the COVID spike where we shut down the economy forever. This is not an easy situation to deal with as a consumer, right? It's very much a challenge. So the reverse repo market is the big deal. This is the big elephant in the room, and I just wanted to show that if we can grab this from the Fed, but also we can look on something like TradingView. And TradingView will actually show us the declining of the reverse repo market. Now, this is something that I was talking about last time, that there was a kind of underlying potentiality for this to be a problem. As I said, if the selling pressure is so strong that even a massively buying reverse repo market isn't able to stabilize it, something really bad is happening. And that's basically what we're doing. We are literally going through a crash right now, and this is just stabilizing it, right? It's making it to where this would be significantly worse if there wasn't some sort of cash in the account to be buying some of the lack of liquidity in the bond market to stabilize the front end of the yield curve. But as this drains, and as this gets closer to zero, or the likelihood that it's going to be there to stabilize things is actually worse, or is gone. So volatility will kick up, everything will ramp up. So basically we have turned into a crash. Now, one thing that is kind of a positive note is that it really has dive bombed over the last couple days, and the stock market has kind of somewhat stabilized. Yes, it's going down, but it's not, necessarily full out crashing or anything like that. So that might provide some stability. And like I said, we should get to a bottom here soon where we kind of stabilize. And if the reverse repo market drains for a little while, we should be able to do that before our next leg down. The home affordability, this has been just a nightmare. As we've been watching this, we knew that eventually, it had to crack. But Airbnbs are there, so it can keep prices high, things like that. But as their cost to carry gets higher, even for Airbnbs and things like that, or if you start to get increasing vacancies, you'll have to actually sell those assets. So we'll see what goes on from here and how this ends up transpiring. But just keep in mind that now that we've had a further spike in interest rates, you can see that the affordability is actually going the opposite way again. And that should be the death sentence for the housing market for the single family homes. And this should actually create some price drops from here on out. So welcome to the housing crash. And now we've got our sentiment, and this is almost comical. Remember last time I talked to you guys at the end of August, or at the beginning of September, end of August, we were talking about how kind of bullish everyone was, and it was just like, all right, guys, it's great, because this is a good quarter, but we know that we have this like lingering recession at the end of the year that we're going to have to deal with. And so now we are just kind of watching the cycle as it goes the other way, and it shouldn't be a surprise to us. But now the bearishness is starting to come back out, all that kind of stuff. We are getting relatively high on the bearishness, so it is about time for some sort of short-term bottom, maybe another flush out or something like that, maybe another week of selling. Could be today was the bottom. You never know, right? But we should start chopping around a little bit more. All right, we did break into our double digits for our lending, so that was always really cool that we got to do that. And so, of course, the more we do, the more we can make an impact. I did have a question, or a couple questions actually come through that I'm going to knock out really quick. But before I do, let me make sure that nothing's came through. Nope, we're good. Okay, so the questions that I've got that got sent to me are just kind of some regular questions that I think just kind of are simple, and I think they just fall onto people's minds sometimes just to see if we can get some sort of an answer, right? So how long will this recession last? So recession / depression, right? So typically I'm just going to kind of look back at some historical ones. From the uninversion of the yield curve, typically we have about 6 months before the bottom in the stock market, and we have about 8 to 10 months before the bottom in the actual economy. So just to kind of keep that in mind, so that's typically 6 months of the stock market from the uninversion, right? So that's uninversion is basically right now. And then the economy is normally 8 to 10 months. So that's the economy, right? Now, this would be for a normal deflationary recession where we've got plenty of room to drop interest rates and kind of all that jazz. The other situation is when we start looking at kind of inflationary recessions where we start to have a little bit more of a problem. Inflationary recessions typically last a little bit longer. So if you notice that these recessions are a little bit wider back here and they kind of come faster between each other, right? So in that case, we can actually get anywhere from, yes, 6 months is still in there, but that can go all the way to 9 months. So 9 months for the bottom of the stock market. And then this is the thing, is it takes the economy actually a little bit longer to deal with things. So for the economy, we're actually 9 all the way to 14 months. So just because we actually get a bottom in the stock market because we start to do some financial trickery and stuff like that, that's actually typically it's still pretty far off from the bottom of the economy. So the economy and the middle class and the working class will definitely feel this for quite a long time. But the thing is that they actually don't feel it yet as bad, right? They will, but the thing is that they kind of, unlike the stock market loses a lot of its value from the highs. The working class or the regular population ends up losing a lot of their value during the depths of the recession when everyone starts to get fired and the unemployment really starts to spike. That's when they feel their losses because they work for their money versus assets being devalued, right? So typically the way that the sine wave works, let me find my marker. So typically the way the sine wave works is you've got the stock market, right? And then you've got the so this is stocks, and then this is the working class, right? So typically, even though the stocks are kind of melting down, what ends up happening is actually the working class can fare a little bit better off, because typically things get a little bit cheaper, so they kind of feel a little bit better. But little do they know that this kind of rollover right here is actually going to be a bigger problem. And so they're kind of fine and they're okay for a little while, but then eventually businesses really start to sell them off and really start to fire them, things like that, right? We are currently probably, if I was going to kind of guesstimate, I mean, we're probably right here as far as our metric goes. So right now, the middle class is probably feeling, pretty okay, right? I mean, yes, inflation's high, but it's like it feels manageable right now, right? Yeah, it's not going to be so. All right, what will likely be the best assets after the recession, and what will be the worst during it? So yeah, I'm going to kind of flip this around. Of course, now just to kind of be just a little bit of CYA right here. I'm going to speculate just based on the kind of mechanics of things that are going on. There is business growth, right? That could be very high potential in the fact that we can probably bring manufacturing back here. We can make a lot of efficiencies in AI as far as business is concerned, things like that. The deal is who are we going to sell those products to? That's the kind of issue, right? Is there the demand? And so we've got to kind of deal with the demand versus what we can do with efficiency with AI, because as AI and machinery and robotics really do take over, you're not going to pay the working class, because that's not how it works. So there's kind of a supply and demand that goes through. But either way, things that are, at least for now, getting government money, those are always great assets, right? So anytime that you start seeing the government putting money in a specific part of the economy, such as robotics or manufacturing or AI, right? There's also right now there's a lot of energy money that's coming through, right? About renewables and things like that. I think those are all good spaces that will deal okay. Now the worst ones during the recession, definitely any kind of balloon asset that dealt with a lot of bad debt that had to project out very far in the future, right? So that's typically commercial real estate. Real estate is the most leveraged asset in the world, right? Everyone leverages real estate to the max, and you can leverage real estate significantly higher than any other asset. So that's going to be the problem, right? Towers and definitely different parts of the city, things like that. So as far as the commercial real estate REITs, I do think that Airbnbs are going to have a problem. The reason why I think that is because typically just in general, hotels go down during recessions, right? Because there's not as many people traveling. And what I think could happen that would be kind of the worst situation is not only do the Airbnbs not have tenants in it, but then their cost of debt is higher. And then on top of that, their asset, which is the house itself, is actually going to go down in value. So that could be like a triple whammy and really have companies that, host and build a bunch of Airbnbs, those would be an issue. So, and then, yeah, after the recession, I definitely think that real estate is going to be probably one of the best assets to hold. Gold and real estate are going to be freaking amazing after all of this. The main reason why is because inevitably the Fed's going to have to print. They will. They always do. They're going to have to. There's no way around it. It's going to be too painful. And so once they start printing, once they turn on those things, you're going to devalue assets again. But remember, it's not going to necessarily be CPI assets, right? Because they're not going to necessarily print checks out to people. What it's going to be is financial inflation. So that should kick up real estate, gold, and then inevitably just stocks in general. But what'll happen is it'll be much more towards high leverage, high beta stocks will probably be some of the best during the bottom. So, yep. That is what I've got so far. And let me go check on you guys. If you guys got any questions or anything like that, just kind of throw it in the chat and I will knock them out right here. If not, I'll wrap it up there and I'll see you guys next month or in the forums if you're over at atradingedge.com. Or if you're in Aramir, you can always reach out to me as well. And I'll talk to you guys next month since I don't see anything coming through. All right. Have a good one.